Welcome to Central Bank Central. I'm Kathleen Hays. Well, what a week it has been. Political environment heating up, geopolitical environment heating up, more and more news either about Jay Powell and the charges launched against him by the Justice Department about mistestifying or lying when he talked to Congress a few months back about building renovations. And meanwhile, the data on the economy looking quite good on many, many fronts. So I'm very happy to welcome back to Central Bank Central, Robert Kaplan. He is vice chair at Goldman Sachs. He's also formerly a member, in fact, not only a member of the Fed, but president of the Dallas Fed. He, in the past, also was at Harvard, the business school, as the Martin Marshall Professor of Management Practice. So long intro, a long, successful bio. But let's get right to the Fed. As I said, the big enchilada. And it seems in a way, I've done already two interviews this week about this, about that particular topic for the Fed. But we're also waiting and thinking, in fact, a Republican senator said, we can't move ahead on the next Fed chair while all these questions hanging over Chair Powell and the Fed independence. We learned from the Wall Street Journal this morning that, in fact, the president has ruled out Kevin Hassett. Kevin Hassett, a loyalist to Trump. Kevin Hassett, former head of the Council of Economic Advisors under Trump. Kevin Hassett, who worked at the Board of Governors, has been in the Fed. He's out of the picture. So just a quick reaction there, and then put it in the larger context of what all this does mean for the next chair.
Well, let me simplify all this. I would guess the case will get resolved. Uh, I don't know that we'll be talking about this at all 3 or 4 weeks from now. However, the one imprint from this brouhaha earlier in the week will be, I think the bar uh, is higher for whoever is going to be the Fed chair to, in Senate confirmation and in taking the job, the bar is higher for that person to demonstrate that they're going to do the job without regard to political pressure, political influence, or political considerations, i.e., that they're independent. And so that, my guess, will be the lasting imprint from what happened earlier in the week.
So, do you see any remaining questions about where this case goes? There's some big Supreme Court decisions coming up that could affect how uh, what is cause for
So
getting rid
there's a
of a Fed
separate
official.
that's a separate issue, which the Lisa Cook situation that will also get resolved one way or the other. And I wouldn't even endeavor to predict what will happen there. But I think the reality is Jay Powell will finish being chair in May. Uh, some people have speculated about whether he will stay. I would personally, I don't know what he's going to do, but I would personally be very skeptical that he will stay beyond being chair for a whole range of reasons. And again, the imprint of all this, though, remember the Fed in December voted unanimously to extend the term of all the presidents, the sitting presidents, for 5 more years. I know there'd been some concern about that. So to me, the next Fed chair is less likely to come in with 7 votes wired. That person is going to need to will be engaged in the debate, disagree, persuade, form a consensus. They're going to have to do that. And I think, though, again, what happened earlier in the week literally just is a greater onus on whoever the candidate is to show that they can engage in that debate without regard to political pressure, political threats, or political considerations. And I think that's the lasting imprint of what's gone on.
Well, this week, looking ahead, financial markets, vice chair of Goldman Sachs, what's sort of the other big hat you wear now, and of course, you continue to be a a great commentator, thought leader, I think, on looking at the Fed and Fed policy. But when we look at that, what are you picking up? What are you hearing from your trading staff? What are they saying about, is this going to leave any kind of lasting imprint on the markets, and how nervous maybe, the bond market is about, is this really over? What is this going to mean for Fed independence, or just where the Fed goes?
I think the only imprint you can see, I don't think equity markets, not apparent that they've been affected. The bond market, not obvious. I think you are seeing, again, gold is up 70% since since the beginning of 2024. So there are investors in the world who, for a range of reasons, and what happened this week was part of that mosaic, want to be allocated to the United States, want to own risk assets, but want to buy some tail protection.
Hmm.
Vol is low, so you can buy protection in various forms relatively inexpensively, and they want to buy gold as one other tail risk protection, and they're a little less likely to want to own the 10-year Treasury as tail risk protection. That's somewhat new versus years past. And so that imprint also you do see in the financial markets.
Well, I think that gets us to some of there's some other big questions I think about Fed accountability and the big picture when we look down the road for the Federal Reserve in terms of, but let's put that to one side, because since we're talking about the 30-year bonds, since we're talking about the markets and you're talking about gold, et cetera. Well, in terms of wanting to buy gold or wanting protection, where does that come from? In terms of inflation, in terms of growth, the last time we spoke, for example, you were pretty positive about the economy and how
Still
well it would
am.
do next year. Yes, you are. And then the latest data, retail sales, jobless claims, the Fed manufacturing surveys, everything is coming in
We
many times stronger than expected.
so let's start with the outlook. Our Goldman Sachs economists, but this is true of the Fed economists and others, we're expecting a strong GDP growth year in 2026. Why? Number one, tax incentives, tax refunds from last year, plus tax on tips, tax on overtime, accelerated depreciation, very significant. Regulatory reform will start to manifest itself more in 2026. What's an example? The banking industry will get new capital rules. You're going to have more bank capital available to put in the economy. And then the obvious one, we're going to have another year of a big capex boom in AI, data centers, power. That's the infrastructure part of AI. That's before we get to what is the productivity enhancement from AI and GDP enhancement from AI adoption. We're in the early innings of that. It may take X number of years for that to unfold. When you wrap it all up together, I think Jan Hatzius, our economist, has got a GDP forecast for next year of 2.75%. That's a significant GDP growth. In that context, this is why I've been saying for a few months, I doubt that there's going to be a cyclical weakening in the labor market. I think some structural issues. But remember, October, November, we had a shutdown. I would expected the labor market to be weaker. Okay. This is why, and for December, I've said I would be inclined to have argued against a rate cut in December. I don't think I would have dissented, but I would have argued against it. And the reason is we know we've had a view for a while that 26 is going to be a strong year. And so it's less likely that you're going to get a cyclical weakening in the labor market. Again, you're going to get some AI related and other structural issues, but I don't know that that's the Fed's role. And in addition, the Fed has cut 75 basis points now to buy insurance for the labor market, and we're now in the neighborhood of neutral, in my opinion. Neutral, in my real 3/4 to 1% is the real neutral rate, and then add the inflation rate at the moment, pick a 2 3/4, 2.7. It's kind of in the neighborhood of where we are. The reason the Fed may cut in 2026, but it will be in response to continued improvement in inflation. We may well get it. Our forecast at Goldman Sachs is that we will. Okay, why? You've got
Yeah,
two,
why? Because yeah,
well,
it's been 4.5 years, well above target, close to
you,
3%. Hasn't come down that much yet. It's come down, but not to where many people say it needs to get, which is a 2% target.
so they, up until 25, the pattern on inflation was goods were disinflating and services was sticky. We interrupted the goods disinflation with tariffs. However, after tariffs have been set, assuming they stabilize, which appears they are, uh, the reality is we've got global overcapacity in manufacturing. China just announced a record trade surplus because we've got global over that still over the horizon. That goods disinflation, we'll have to see whether that resumes. It might. In addition, AI over the horizon is going to improve productivity. We're already starting to see it. That over the horizon should be disinflationary. So, what I don't know is what the timing will be. I don't know that there's going to be inflation improvement in the first half of 26. But if I'm at the Fed, would it surprise me that as the year goes on, we see some moderation in inflation? It's possible because there's two big structural forces. There's other counterwinds, but there's two big structural forces that are disinflationary. And so if I'm at the Fed, I'm not going to anticipate it though. And what the administration wants, and probably the next Fed chair will argue, is we should anticipate that disinflation. That's why they're comparing this to the 90s, where they're saying, you know, there was the internet boom and there was disinflation, and Greenspan anticipated it. Uh, they're going to argue that the committee and the center of gravity on the committee, and where I would be if I were on the committee, is I believe the narrative, but I'm not going to move until I see progress. As you said, inflation's been above target for 4 or 5 years. We're at neutral. I don't have room to move anymore unless inflation demonstrably improves. And that will be the tension at the FOMC. Okay. But I think this is why they're not going to move in January, and they'll take it one meeting at a time, and let's see how things unfold.
But again, just to underscore what I think you're saying is they have to see it. They can't just say we expect inflation to
That's
come
right.
down, right? That they're actually going to see month by month or
Yeah.
year over year numbers
And
showing that they are coming
and they
down.
leaned into labor weakness despite the expectation that 26 was going to be a very strong growth year. And I think so. I think they gave a lot in terms of 0.75% insurance despite that to try to stabilize employment. I think that insurance purchase is now complete, and I think now they need to see either further labor weakness, which I think is very unlikely, or need to see inflation improvement before they act.
Okay, so do they have to then more explicitly state things that many economists have said for a while now that we are in a different labor market now, and people have talked about right, slow hiring but very slow firing, and a world where you've talked about AI, we're starting to see the effects. Many people say increased productivity, but you're just not going to see the kind of payrolls growth that you used to see.
So
That's
I
what I
would
think
say
we
it
totally
different.
see there.
I would say it differently. I would say I personally think it would be a good thing to differentiate between cyclical weakening, i.e., weakening in hiring because the economy is slow, versus structural weakening, i.e., businesses anticipating uh, AI, other technology improvements, and are moderating their hiring. We also have a lack of supply. Uh, and I think we're undergoing, and we're starting, and we're in the middle. We're starting early innings of a structural change in the labor force. So, what's an example? Uh, Millions of drivers over the next 5 years, at some point, are likely to, some chunk of them are going to lose their jobs. Those workers are going to need to get retrained and get into the labor force. And the problem is it's going to happen abruptly. And this repotting doesn't happen overnight. This is why early childhood literacy skills training is very vital. And the reason that you're going to see challenges is this is happening very abruptly. Over the fullness of time, I'm confident you will get a rematching. But what we're seeing at the moment is we got lots of people looking who can't get jobs, college graduates, and we've got more open jobs in certain industries than I can remember seeing in my business career. Window installers, people to work on the Ford Motor Company assembly line, as the CEO has said publicly, electricians, plumbers, etc. The problem is the people looking don't want those jobs, even though they're very lucrative jobs. We're going to have to get some rematching, and there will be new jobs being created as a result of AI, including some titles and functions that I never heard of before, but they're gonna happen. Prompt editors and things like that, which I've had to learn what that is, but it will happen. But I don't think that's the role of the Fed to
Hmm.
I think this is my own view, some would disagree. I think the role of the Fed is to focus on a cyclical weakening. I think monetary policy affects demand, but I don't think this is a demand problem. This is a
No.
structural issue. And so, having said that, I would argue the Fed tilted toward dealing with anything that a part of this that might have been cyclical, and it did the three quarters, did the three cuts. But I think we're now. I think they need to differentiate between structural and cyclical. What's the role of the Fed, and what's not the role of the Fed? And I think they can be more balanced now, and also focus on seeing inflation improvement.
So again, in terms of AI growth, who it benefits, data centers, the building, the construction part, that sounds great. Do you look down the road 10 years? What role is AI going to be playing then?
When we talk 10 years from now about AI, we're not going to be talking about the infrastructure build. We're going to be talking about the degree of adoption and which use cases, if we even remember, which use cases worked and which didn't. And we're going to be talking about the productivity impact uh, of AI. And we think that can add as much as or more than a half a percentage point to GDP growth through productivity growth. That would be a huge deal. I'm optimistic that we may see that. We may find cheaper ways to do the infrastructure, more cost-effective ways to do the infrastructure. I think the key will be, when we're talking 10 years from now, what's been the productivity impact and the degree of adoption and widespread use cases. And I think we're going to learn an enormous amount over the next 3 years about that. But we're early innings, in my opinion. China, in my visits there, I'm about to go again in a couple of weeks, China's further along in the AI adoption story. McDonald's China operates somewhat differently than McDonald's the United States, use of AI. So why is that? Margins are thinner. This is the business people at least tell me, margins are thinner. There's a greater motivation to take risk in adopting AI. Margins in the United States are higher. Our businesses make more money. They will also adopt AI, but they'll take more of a push from the top in these companies. But we can learn a lot here about lessons they're learning from AI adoption, where they're a few innings ahead, I would argue, in China.
Let me switch gears a bit here to Venezuela. It's certainly one of the geopolitical questions hanging over the Trump team. A lot of people applauded hugely because the Venezuelans have finally been freed from a terrible dictatorship.
Yes.
But a bigger question, or not bigger question, to me, that is the most important question. However, broadly speaking, and for markets, people look at oil. You're in Dallas. You've been a Texan for a long time. Uh, what does this mean about the supply of oil prices? Maybe not a lot because it's so heavy and you have to do so much to refine it, and or just kind of then our the oil as a policy card in the world now that the U.S. has made this step.
So I'd say step one, phase one, to the extent there's been an impact on the oil price, it might surprise people that it's been limited. Some, so why is that? There's a little bit of a debate about what are the accurate numbers for Venezuela in terms of oil reserves. There've been numbers mentioned as high as 300 million. There've been a range of numbers, and I think there has been some folks I talk to in the industry are cognizant that the actual reserves that are addressable may be a portion of the headline numbers. Maybe the country itself, for various reasons, overstated. But we're going to find out, number one. Number two, in order to invest there, that's not a 2 or 3 year investment. That's a 10 or 20-year investment. And then you need to be confident that there's going to be a stable environment where you don't need to worry about the pendulum swinging back and seizure of assets. And you want to know this is going to be sustainable stability. And I think that's what many of them are talking about among themselves and their companies at their boards, and are talking to the administration about, we're going to make a multi-year investment, but it's going to extend past this administration and future ones. And so that's why you hear folks in the administration asked about security guarantees and what role we're going to play, because these are long-lived investments. These are not quick investments. They're multi-year investments. The industry is focused on that and is working through that and assessing it.
Okay. Is there anything about some of these larger geopolitical issues? We've got the war, Ukraine, Russia. Certainly, if you're talking to anybody, even not just European officials, but central bankers, and depending on how close you are to Russia, it's a pretty big deal when you have someone in the Baltics, right? But what do you see
And it has
anything?
a big effect on Europe in that people are taking a fresh look at Europe. Germany is investing more in obviously fiscally and defense spending. I think there's a hope that if we're doing regulatory reform in the United States, that Europe will do, maybe not, won't go as far as we go, but will do some. And so people are taking a fresh look at Europe as investing, and resolving the Ukraine-Russian war and stabilizing that situation is part of that calculus. But to your point, what's going on around the world, here in this hemisphere, in Asia, and in Europe, the only comment I would make is, we talk to pools of money, and I do, all over the world. I'll get down to the bottom line. They tend to be heavily allocated to the US, no matter what country they're in. I think a year and a quarter ago, if they were going to invest more money, they wanted to get more over allocated to the US. I think we've obviously changed some things here. There's the tariffs. There is some of the domestic changes we've made. There's geopolitical issues. And what we're hearing a little bit more on the margin is people hedging the dollar, looking to diversify a bit away from the US on the margin, though, taking a fresh look at Asia, taking a fresh look at Europe. However, they're going to still likely stay over allocated to the United States. And the comment you hear from people is, if I had to make a 20-year bet, my highest conviction bet is the United States, but there's more tail risk. All this comes under the heading of, do we understand the institutional framework, global norms, institutional, domestic, and global norms? And we want to buy a little more tail risk protection. And again, back to, it's why gold is up 70%, but it's also why people are taking, on the margin, a fresh look globally at other markets.
Well, go a little deeper there. Tail risk. What did you just say? Institutional arrangement, et cetera. What are you getting at there? Are you
Well,
saying, yeah, you still got to be
let's go.
overweight US, but you got
I'll
to be
say
careful
this.
because of all the things that are going on, including at the Fed?
I'll say it's part of the puzzle. So there's a number of issues. None of them may be life-threatening. We've been a magnet for talent in the United States. Maybe a little less welcoming now for high-end talent, which has been critical to the brain inflow and innovation inflow. Higher education, I'm hopeful we'll get through this period where the university system in the United States will still be the envy of the world, but there's disputes and there's more challenge now. Some of the domestic situation where I don't even want to go into it, but ICE troops and federal troops in different cities, we may manage through it, but that's a new development. Um, the independence of the Fed is part of that. Uh, uh, what we just did in Venezuela probably net will turn out to be a good thing, but it's unusual compared to what we've been doing. Again, if you take the whole mosaic, the only people are saying is, I'm a little less sure that I understand the norms, the institutional, what the unpredictability. I think we have the opportunity to manage through it. I think the world can manage through it, but people are risk managers who are manage pools of money, and they're just saying on the margin, there's a little more tail risk means there's a change in versus institutional norms, a change in behavior, and one of these we may miscalculate. And if we
Okay.
and it will wind up having a chilling effect on economic activity. I think everyone is hopeful and optimistic that won't happen, but on the margin, they're buying a little tail risk protection against it. And we're seeing that.
Okay. Do you think there's a risk coming back to the Fed that, okay, well, who knows what's going to happen with these criminal charges? The investigation's underway. One person I spoke to this week said, "So go ahead, let Congress have a hearing about this. Let's look at the exact words that Powell
I
said."
would
That's
guess
it.
just
That's
to
okay.
preempt, just to truncate this, I'd be surprised if we're talking about this a month from now. That's
Okay.
just a guess as from the cheap seats. What do I mean by that?
Cheap seats.
We're going to have a chair leaving in May. Could take 2 or 3 months to get a new chair confirmed. I don't know how long the Senate process takes. I mean, somebody's got to get nominated here pretty soon, like in the next few weeks. Someone is going to get nominated. Um, as has been said, the bar has been raised in Congress, and some people put out a marker. I want to see some resolution before we name. My guess is, by hook or by crook, this is going to get resolved. The new chair is going to be questioned. The candidate is going to be questioned more than he might have been otherwise about independence. They presumably will pass that test, but all that has to happen to produce a chair that's in the seat in May. So I have a funny feeling working backwards. I don't know how it's going to get resolved. I can't predict the blow by blow, but it's going to get resolved.
Is there any risk that there is a lingering uh, impact on the Fed's ability or readiness to fight inflation? Is there any chance that quite apart from who's going to leave when, and of course the Fed did that masterful move to get ahead of Trump and do the approval, the every 5 year sort of routine approval of the Fed bank president. Someone suggested to me, oh gosh, maybe that's why they reached out and moved ahead with this criminal investigation to say, boom, fight them back or something. But putting that aside, is there a sense now that the US, the Fed, I mean, is going to look a bit differently and be a little more inflation tolerant than they were in the past?
So to put a precision, if I'm sitting around the Fed table with the current participants who you and I both know well, the culture at this moment is we're going to do our level best to make our best decisions to achieve full employment and price stability without regard to political pressure or threats or political considerations. Um, I think that's true with this group of personnel. And I think based on everything I'm seeing, you'll have a new chair. That new chair will argue that we should anticipate, again, inflation improvements. I think the committee, by and large, the center of gravity is I want to wait till I see it. They'll debate it out. And I think it'll be people around the table will do their level best to screen out all this, I call it noise, going around and what's happened this last week and over this period. And again, unless you have dramatic change in the people, I think that will be the culture and the challenge for the new chair. New chair can move the group, but he'll have to do it through debate, disagreement, and persuasion. And I think that'll be the challenge that's on monetary policy. Let me make two other comments. Don't forget on regulatory policy, it has been customary for the last many years that new administration puts its imprint on regulatory policy. That's going on right now. I think the new chair will be an active partner
Okay.
with Mickey Bowman on regulatory reform. And the third thing, which no one's talking about yet, Could there be some closer cooperation between the Fed and the Treasury about managing the Fed balance sheet? Yeah, that could happen. But on setting the Fed funds rate,
Okay.
um, I think based on what I see now, the new chair won't have 7 votes wired, and he'll have to have debate and disagreement. On balance sheet and on regulatory policy,
Okay.
you may see some change in emphasis, acceleration, different discussions. That's possible.
Do you think it'd be better if there was a little more cooperation between the Treasury and the Fed on
In
issues that affect the balance sheet, that affect these things that are also big questions hanging
in
over bond market?
in a country that has on its way to 40 trillion of debt it owes, um, and with the Fed owning a balance sheet of six and a fraction trillion dollars, and it has a meaningful imprint in the mortgage market. Would it shock me if there was some discussion about the Fed swapping its mortgage portfolio with the Treasury for in return Treasuries? I'm just throwing, I haven't heard this, but would it shock me? No, it wouldn't shock me. And could I think it could be done in a constructive way? Could be. I wouldn't rule it
Okay.
out.
You mentioned Mickey Bill money. Just have to ask you quickly then. The vice chair for supervision, came from the community banking world, and a very, very well respected official. She says too much bank supervision right now. Got to get rid of a lot of this bank supervision. Do you agree?
Mhm. I think we could use more prioritization of what are the key issues we want to tightly supervise. And I would say there are some items there have been so many priorities, and that I think banks can lend more money, get more money into the economy. We're an aging society that's over leveraged. We need more growth. I think you could have more balanced regulation without losing a lot on safety and soundness. And I think a more balanced, more transparency in the stress tests, supplementary leverage ratio being changed, more tailoring for small banks of regulation. Do I think that can be done constructively? Yeah, I do, in a manageable way. In a country that needs more growth, that needs to deleverage and has very large government debt, I think things that generate more growth. And by the way, that regulatory reform could wind up net being disinflationary also. Create more product, set the seeds for more productivity growth in the US. So I think it could be done in a constructive way.
Okay, well, Rob Kaplan, thank you so very much. Actually, I'd say overall, you have a very positive view, I think, of the economy, what's driving it, what's going to happen to inflation. Finally, where's the
As
Fed
long as we manage the tail risk.
as long as you manage the tail risk? Okay, well, we'll have to talk about that more. But
But
what's the
yes,
number one tail risk?
the outlook is very constructive, and we're optimistic, and we're seeing an activity for 2026, and we are set up for a very constructive year. Yes,
Okay, funds rate at the end of the year?
it wouldn't shock me if I mean, I would have guessed 1 or 2 cuts, but I don't know. And if I'm in my former seat, I wouldn't
Yes.
make any prediction at all.
Okay. Well, my prediction is we'll see you again soon.
That's a good one. We can agree on that one.
Okay, Robert, thank you so very much. He's vice chair of Goldman Sachs. He is also former Fed Reserve Bank president at the Dallas Fed. So that's it for Central Bank Central. I'm Kathleen Hays.